and very good afternoon to the mutual fund. My name is Vandita Shivle and I'm here to take you through your queries. Alright, let's start with the first query now. That's coming from Divakar. He's from Cochin and he's asking me that he has been investing in a fund called Hdfc Small Cap for 1 year now. He's not happy with the returns. Should he stay invested or exit? That's his first question. Second, he's not sure how to manage volatility. If I could guide him on that. Sure, Divakar, I'll help you with that. It's a very good question that you've asked me, and it's very true with regards to the current market scenario. Number one thing, Divakar, here is, before I answer your question, should you exit from HDFC small cap or not? I want you to analyze this. When you invested in this HDFC small cap, did you read the scheme information document of the scheme? Because if you would have read it carefully, one particular thing would have been mentioned on the investment objective. How is the scheme, how is the fund manager looking to generate returns? It is a long-term capital appreciation. That's how the capital will grow. Capital will grow, but in long term. That's how the fund manager is going to manage the fund, right? So when this is the objective of the fund, should you stay invested for 1 year, 2 years, 3 years? No, it's an equity diversified fund, and that too, it's a small cap fund. Small cap fund means that the fund manager is aiming those small cap companies which he thinks, the fund manager thinks, has a good perspective. So the fund manager is having a vision in his or her mind. And that's what Chirag has done here. He is thinking in his mind, how do I grow this fund? He is believing that these small cap companies' market cap will grow. But to grow that market cap, is 1 year enough? No, it's not enough. You need to give the fund some time. You need to stay invested for over 5 years. I would say 8 years is the minimum time that you should be looking at while you are investing in this fund. And definitely it's a very good fund, HDFC small cap. In the small cap category, it is one fund that I have been recommending my clients as well, because this fund has really done well. Ask the investor. Today you are asking me this question, that should I stay invested in this fund for because in 1 year they have given you negative returns. Of course they will give you negative returns, and the reason is that small caps have not done very well. Mid caps and small caps have been shattered in this. They have seen a very bad phase in the last 1 year. From 2018 they're not doing very well. And but yes, a lot of analysts are coming up with a lot of reports, and they will see that because there have been some correction. Earlier they were overpriced, and now we have seen some correction in the market, and you will see that this fund performing. You will get that averaged out returns from the market, but stay invested, do not exit, at least for 5 years. That's my recommendation for you. That's the answer for your first question. It's a very good fund. Second, you asked me, how do I manage volatility? Okay, see, number one thing, whenever a market participant looks at volatility, he thinks only one thing comes to that person's mind. When will the market bottom? When will it bottom out? I mean, come on, you are not looking at the upward trend, the potential of the market. You are just looking that as of now, the markets are not doing well. So that's why you get this anxiety, you get nervous about the markets. Ask those well-informed investors who have been, in the market for over 15 years or even for 5 years. They would tell you that this is something which is a part of market, fluctuating markets and everything. But all you have to do is you need to be resilient under pressure. You need to be consistent. You need to understand one thing, that when markets are going down, they will come up as well, right? So you need to have that kind of faith in the market. Now, what can you do to manage and fight that volatility? You can never say that volatility is not going to happen. Okay, so you can't be doing that. So I would say when you come in market, you have to come with a mindset that I need to build a portfolio that is resilient in these kind of market scenarios. And for that, investor behavior is very important. Number one thing is you need to stay for long term to get the maximum benefits out of the market. Don't come out in a short-term environment. This is not trading. This is investment. You need to understand. You will not see names of big traders, but you will see name of big investors, right? Warren Buffett was not a trader. He was an investor. So think on those terms. Whenever you get married to someone, you look at entire history of the person and you think that it's a long-term relationship. But when it comes to investments, the thing is similar. You are getting married to a company, you are buying assets of the company. So you need to be sure what kind of company you are looking into and how you are going to park your money. So I would say long-term investment horizon is extremely important here. That's number one. Number two, a very, very important mistake that people do is SIP. They don't invest via SIP. SIPs have a power. SIPs can help you give those returns which a lump sum investment cannot give you. But these SIPs should be consistent. What happens basically is in a mutual fund, whenever you buy, there's an NAV at which you buy a scheme, right? And you get it in units. For example, your investment amount is 10,000 and there is a NAV of a scheme which is at 20, right? Now at 20, your investment at 20 NAV, your SIP investment of 10,000, how many units do you get? 500 units you buy, right? Now, similarly, you have 10,000 rupees, but now the NAV is 16 and not 20. How many units you are buying? 10,000 divided by 16. Almost over 600 units you are buying. 500 versus 625. So whenever markets are down, you actually end up buying more units. Understand this concept, use it to the maximum possible level because this has a power of giving you those returns which none of the, instrument can give you. So whenever NAVs are down, it's good for you. You can end up buying more units. Please understand that. Buy via SIP. Be consistent because SIPs can give you can average out your market returns. And it's very important to stay invested with a mindset that I am going to give, if I have decided 5,000 SIP per month, I'm going to do that. If not, then I'm not going to enter the market. So this is a very, very important lesson. These two alone can help you manage volatility. I am not just saying this for the sake of saying it will reduce your anxiety to a great extent because you're not investing more money also, right? You're just giving 2,500, 5,000 a month, right? Even if the markets are going down, it will not hamper your mind so much. Imagine if you would have invested 1.5 to 2 lakhs in a month, right? And the markets are volatile, then it's a problem, right? At one shot when you pay, you are always, in a mindset that what do I do next? So these are the tools with which you can manage volatility. Stay invested for a long term and you will see that if you are doing SIPs with the right manner, you're not missing out days in between, you are disciplined, you will get the returns that actually scheme promises to give you. Right? So that's very, very important. Give that fund manager a chance at least to prove himself, right? So that's the advice for you, Chirag. And Divakar. Chirag is the fund manager of Hdfc fund, small cap. So, that's coming in my mind. All right, look at the upward trend and I believe that you are good to go. All the very best with your investments. Let's move on to our next question now. That's coming from Adarsh Kumar from Mumbai. He's saying, I want a good debt fund for 15 years. I want it to grow. Okay. And he wants my suggestion on that. Adarsh, I don't think you understand the concept of mutual fund right now. You need a financial advisor here. I would say that don't just invest on your own. You definitely need a financial advisor, good financial advisor. Why? Because you're saying that you want a good debt fund for 15 years for growth. Debt fund is for your income based needs. Debt funds is for your stability in your portfolio. Debt fund is not for growth. When you look for growth, it's equity funds. 15 years, if that's your mindset, doing an SIP for 15 years, it's not debt fund that you should be targeting, it's equity fund. And in that case, I can recommend you, I think you should go for a large cap fund. Mirror Asset large cap fund would be good fund to go with, but debt fund for 15 years, no, I'm really sorry, that's not a right question as well. And I would want to explain this to investor. Debt and equity funds, please understand the difference. The need of the investor determines where you want to go. If your time horizon, if your investment horizon is 3 years, go for debt funds. If your investment horizon is over 5 years or 5 years, it's equity diversified funds where your money can grow, right? Also understand that when you say debt fund, you are giving loan to a company in a way. And when you are getting into equity, you don't want to give loan for longer time, right? And when you invest in a company, you're buying an asset of a company, that's when you, get into equities. So please understand this concept well. Send me your portfolio, send me your complete goals, how much money you are willing to invest, entire details, so that I can help you better, Adarsh. You are in Mumbai, so you can contact me as well. Definitely, Adarsh, all the very best with your investments, but please be well informed about the markets. But thank you very much for watching me, viewers. That's all for this edition, and thanks again for watching me.